A seemingly simple act may have been the most expensive financial mistake of your life. You might have just accidentally disinherited your child from a massive tax break, triggered a property tax time bomb, and unknowingly created a gift tax headache with the IRS. But I'm here to tell you with a real sense of urgency, thinking you were dodging one problem, probate, but you may have walked right into a minefield of tax nightmares. This video is for the children who are trying to help their parents update their trust, understanding their desires, or us, their adult children, trying to make our own plans. Our parents have worked their whole life to build something special here in Orange County. You scrimped, saved, made sacrifices, and finally you paid off your beautiful home. It's more than just a house. It's the backdrop to decades of memories and likely the single largest asset you own. Naturally, you want to make sure that when you're gone, your home passes to your children as simply and painlessly as possible. I'm going to speak directly to the parent. Somewhere along the line, you heard a piece of advice. Maybe it was from a neighbor, a friend, from the golf course, or something you saw online. The advice was simple. Just add your kid's name to the deed. It's cheap and easy way to avoid probate. It sounded like a brilliant life hack. A simple form, a quick signature, a small filing fee, and you've saved your kids from the dreaded California probate court. So, you did it. You signed that quick claim deed, added your child as a joint tenant, and felt a wave of relief. But I'm here to tell you with a real sense of urgency, you thought you were dodging one problem, probate, but you may have walked right into a minefield of tax nightmares. Please subscribe to see more videos dealing with inherited property here in Orange County, California. For years, my practice as a realtor has focused on helping families in communities from Irvine to Anaheim understand trust and probate to protect their wealth in a simple way. Easy to understand language. So today we're going to dissect this terrible piece of financial advice. I'm going to explain the gift tax, the capital gains tax, and the Proposition 19 property tax. More importantly, I'm going to show you with real Orange County numbers just how much this mistake can cost your children. And finally, I'll tell you what you need to do instead, the right way to pass your home to your children that actually accomplishes all of your goals without the devastating financial fallout. You love your kids. You want to make their inheritance simple. So you followed that common advice and added them to the deed of your Orange County home. You might have just made the biggest financial mistake of your life. That simple signature may have created a tax nightmare for the very people you are trying to help. I'm going to show you how this mistake can trigger hidden gift taxes, a massive capital gains trap, and a shocking property tax hike, and what you need to do to fix it before it's too late. So why do so many smart, responsible people make the same mistake? It all comes down to a fundamental misunderstanding fueled by a legitimate fear, the fear of probate. You've heard the horror stories. Probate in California is slow, expensive, and public. The idea of your family home being tied up in court for 18 months or more, with lawyers taking a percentage of its value in fees. It's terrifying, and it should be. Avoiding probate is a very good goal. The problem isn't the goal, it's the method. Adding a child to your deed as a joint tenant with right of survivorship seems like a perfect solution. On paper, it works. When one joint tenant dies, the property automatically transfers to the surviving joint tenant by law. No court, no probate, no fuss. It sounds clean and simple. And for that one specific goal, avoiding probate, it technically works. But this is a classic case of winning the battle and losing the war. A proper estate plan is designed to do many things at once. Avoid probate, yes, but also minimize tax, protect you during your lifetime, and shield your heirs from their own creditors or divorces. Adding your child to the deed focuses on the one small piece, probate, while setting fire to all the other more important pieces. It's like using a sledgehammer to crack a nut. You might open the nut, but you destroy the kernel inside and you break the table underneath. You solved a minor problem by creating multiple, far more expensive. Your intentions were good, your goal of avoiding probate was correct, but the strategy you were told to use is a relic from a time before the tax code and California property laws became the confusing journey it is on. It's outdated advice that doesn't account for modern consequences. Now let's talk about those consequences, starting with the most financially devastating: capital gains and the loss of. This is the big one. This is the tax trap that can cost your children hundreds of thousands of dollars. It's all about a concept called step up in basis. And this is the aha moment where you'll see the real damage. First, two simple terms: cost basis and capital gain. Your cost basis is basically what you paid for the home. If you bought your house in Irvine in 1995 for $300,000, that's your cost basis. A capital gain is the difference between the sale price and your cost basis. If you sell that Irvine home today for $1.8 million, your capital gain is $1.5 million. That gain is potentially taxable income. Now, as a homeowner, you can exclude up to $250,000 of gain, $500,000 if married, but even so, you can still have a huge taxable gain. This is where the magic of a proper inheritance comes in, though through the step up in basis. When your child inherits a property from you after you pass, meaning it passes through a will or even better, a living trust, the tax law gives them an incredible gift. The cost basis of the property is stepped up to its fair market value on your day of death. Let me repeat that because it's the most important sentence you'll hear today. When your child inherits your home the right way, their new cost basis becomes what the home was worth when you died. Let's see this in a real world Orange County scenario. Let's say you're a single parent. You bought your home in Garden Grove back in 1988 for $120,000. It's now paid off and worth about $1.2 million. Your cost basis is $120,000. In 2025, you listened to your neighbor and signed a deed adding your son as a joint tenant. In the eyes of the IRS, you just gave your son a gift of 50% of your home, worth $560,000. Crucially, when you gave a gift, the recipient also gets your cost basis. This is called carryover basis. So your son now owns half the house, and his cost basis for that half is 50% of your original purchase price, a tiny $60,000. Now, fast forward, you pass away as a joint tenant. Your son automatically becomes the full owner, avoiding probate. Success, right? He decides to sell the home a month later for $1,112,000. It's time to calculate his capital gains tax for the half of the house he inherited from your death. He gets a step up. The basis for that half becomes its value when you died, or $560,000. But the half you gifted him back in 2025, there is no step up. He is stuck with the original carryover basis of just $60,000. So let's do the math for the tax man. His total cost basis is the sum of the two halves. $560,000 inherited half plus $60,000 gifted half equals $620,000. He sells the house for $1,120,000. His taxable capital gains equals $500,000. A $500,000 taxable gain. He doesn't qualify for the homeowners exclusion because it wasn't his primary residence. Assuming a combined federal and California capital gains tax rate of about 30%, he's looking at a tax bill of roughly $150,000. $150,000 gone, paid directly to the government, all because of one piece of paper you signed years ago trying to help. Now let's look at the alternative, the right way. Same situation. Garden Grove home bought for $120,000, now worth $1,120,000. But instead of adding your son to the deed, you created a revocable living trust and transferred the title to your home into it. You are the trustee. You have 100% control, and your son is the beneficiary who inherits the home when you're gone. Years later, you pass away. Your son, as a successor trustee, takes control. The trust passes the home to him, completely avoiding probate. He decides to sell the home a month later for $1,120,000. Let's calculate his tax. Because he inherited the entire property, he gets a full step up in basis. His new cost basis isn't your old $120,000. His new basis, the fair market value on your rate of death, $1,120,000. So let's do the math. Sell price, $1,120,000. His step-up basis, $1,120,000. His capital gains is zero. Zero. A taxable gain of zero. His tax bill is zero. Let that sink in. Scenario A, $150,000 tax bill be nothing by choosing wrong method to avoid probate. You would have had cost your son $150,000. That's a down payment of a house of his own. It's a college fund, and it was 100% avoidable. This loss of step up in basis is the single biggest financial trap of adding a child to your deed. You're taking a wealth building asset and needlessly handling a chunk of its value to the government. Let's talk about the property tax, Proposition 19. If the capital gains hit wasn't bad enough, there's another tax nightmare specific to California. This one doesn't wait until the house is sold. It attacks every single year in your property tax bill. I'm talking about the dramatic changes from Proposition 19. For decades, California homeowners have been protected by Prop 13, which locks in your property's assessed value and limits tax increases. That is why you might pay $3,000 a year in property taxes while your new neighbor in an identical house pays $15,000. We used to have a generous parent-child exclusion that let you pass that low tax base to your kids. Then in February 2021, Proposition 19 changed everything. It replaced the old generous exclusion with a much stricter set of rules. Under Prop 19, to keep any part of your low property tax base when transferring a home to a child, two conditions must be met. 1, the property must have been your principal residence. 2, Your child must move in and make it their principal residence and file for the homeowner's exemption all within 1 year. If your child wants to use it as a rental, a second home, or just sell it, the property tax base gets completely reassessed to current market value. The low tax bill you've enjoyed for decades vanishes. But even if your child does move in, they still can face a huge tax hike. Prop 19 says the full tax base can only be kept if the home's market value is less than the parent's assessed value plus $1 million. In Orange County, almost every long-term homeowner is over this limit. Let's run the numbers. Let's take a home in Newport Beach you bought in 1992. Your current assessed value for taxes is $350,000. Thanks to Prop 13, your annual tax bill is about $3,850. Today, the home's market value is $2,500,000. You add your daughter to a few years later, you pass away. She inherits the home. She's a doctor in San Francisco and has no plans to move. She decides to keep it as a vacation home. Because she doesn't make it her principal residence, the Prop 19 exclusion fails. The Orange County's assessor's office is notified and reassesses the property to its full market value of $2,500,000. Her new annual property tax bill will roughly be 1.1% of $2.5 million, which is $27,500 per year. Tax bill just jumped from $3,850 a year to $27,500 a year. That's nearly $2,000 a month in extra costs. She may be forced to sell the home she desperately wanted to keep. Or, same Newport Beach house, assessed value $350,000, market value $2.5 million. This time, your daughter uproots her life to move in and save the tax base. Now we apply the complex Prop 19 formula. First, we find the exclusion threshold, $350,000, plus $1 million equals $1,350,000. The market value of $2.5 million is far greater than the $1,350,000 million threshold, so a partial reassessment is triggered. Here's how it's calculated. The amount of value over the threshold is added to your old tax base. The excess is $2,520,000. The new assessed value becomes your old base plus the excess amount. Her new property tax bill is 1.1 of the new 1.5 million value, which comes out $16,500 per year. Or even in the best case scenario, the property tax still skyrockets from $3,800 to $16,500 a year, still creating a financial headache. The way to inherit a living trust doesn't erase Prop 19, but it still provides a framework to plan for it. A simple deed transfer completely lacks. And lastly, the nightmare is a paperwork and compliance disaster, the federal gift tax. When you add your child's name to your deed for free, the IRS views this as a gift. And if that gift value exceeds the annual exclusion amount, you are legally required to file a gift tax return. For 2025, the annual gift tax exclusion is $18,000 per person. That's the most you can give someone in a year without paperwork. Now let's look back at our Orange County homes. The Irvine home, worth $1.8 million, you made a gift 50% or $900,000. The Garden Grove home, worth $1.12 million, you made a gift of $500,000. $960,000. Is $900,000 more than $18,000? Yes, by a lot. Because your gift is so large, you are legally required to file an IRS Form 709, the California gift tax. Now, does this mean you have to write a check to the IRS? Probably not, and this is where it gets tricky. In addition to that annual exclusion, every citizen has a lifetime gift and a state tax exemption. When you file the gift tax form 709, you usually don't owe tax out of pocket. Instead, the gift amount over the annual exclusion just gets deducted from your lifetime exemption. But using up a large chunk of that shrinking exemption on a tax inefficient gift like a deed transfer is a massive strategic gamble. More importantly, this is a problem you didn't need to have. When you use a living trust, you aren't making a gift. You're just changing how the title is held. You retain full ownership. There is no gift, no Form 709 to file, and no impact on your lifetime exemption. It's an unnecessary complication by the simple deed change. If the tax nightmares weren't enough, adding your child to the deed creates a host of immediate legal problems. When you put your child on that deed as a co-owner, you give up control. You're no longer the sole ruler of your own castle. From that day forward, you cannot sell the home, refinance it, or get a home equity line of credit without their signature and their full participation. You made yourself a tenant in your own home, requiring permission to make major financial decisions about your own asset. But the loss of control is only half the story. The other part is that you have now tied the fate of your home to your child's financial and personal life. Their problems are now your problems. When your child becomes a legal owner, your property is now their asset. It's exposed to the creditors, lawsuits, and life events. A lawsuit? Your son gets in a bad car accident and is sued for more than his insurance covers. The lawyer on the other side runs an asset search and finds he owns 50% of a valuable Orange County home. They can place a lien on your home and potentially force its sale. A divorce? Your daughter is co-owner of your home. She gets divorced. Her ex-spouse's attorney argues that her 50% ownership is a material asset. Suddenly, your home is a bargaining chip in their divorce settlement. Bankruptcy? Your child's business fails and they have to file for bankruptcy. The bankruptcy trustee's job is to find assets to pay creditors. Their half ownership of your home is an asset. The court can order the home sold. By adding their name to your deed, you have roped your single most valuable asset into every potential drama and disaster of their life. It's a risk no parent should have to take. By now, I hope it's painfully clear that adding your child to your deed is a catastrophic mistake. So you ask, what am I supposed to do? You told me to avoid probate. You're right. The goal is correct. The vehicle to achieve that goal is a revocable living trust. A living trust is a legal tool you create to hold title to your assets. Think of it as a rule book that you write for your property. You create it, you transfer your home into it, and you manage it for your own benefit while you're alive. The grantor, that's you, the creator of the trust. The trustee, this is the manager. While you're alive, that's also you. You have 100% control. Trustee, the the person you name to take over as manager when you pass away, typically your child. The beneficiary, the person who ultimately gets the asset. While you're alive, you're the beneficiary. After you pass, your child is. Here is why a living trust is the superior choice. It avoids probate. This was the original goal. Because the trust owns the home, the probate court has no jurisdiction. When you pass, your successor trustee simply follows your rules to transfer the home. It's private, fast, and avoids court costs. It preserves the full step-up in basis. This is the multi-$100,000 benefit. Because you never made a gift, your child inherits the property and gets a full step-up basis. This one feature can save them $150,000 or more in capital gains taxes. It maintains your 100% control. A revocable trust keeps you in the driver's seat. You are the trustee. You can amend it, sell the house, or use the money to travel the world. You don't need anyone's permission. It's your asset. It protects your home from your child's creditors. Because your child is only a future beneficiary, your home is shielded from their lawsuits, divorces, or bankruptcies. Their problems cannot become a lien on your house. It provides a framework for Prop 19 planning. The trust itself doesn't magically change the Prop 19 rules. It creates the ideal structure to plan for them, giving your child options and flexibility that a simple deed completely lacks. In every category, probate avoidance and asset protection, the living trust is the only correct option for a California homeowner. We've covered a lot, but the key takeaway is this. The old advice is just add your kids to the deed is a financial time bomb. It comes from a good place, avoiding probate, but it triggers a cascade of devastating consequences. It destroys the step up in basis, costing your kids a fortune in taxes. It sets off the 19 property tax tsunami, and it forces you to give up control while exposing your greatest asset to your child's creditors. The right way to accomplish your goal is with a properly drafted revocable living trust. So, what should you do now? If you are an Orange County homeowner and you're even thinking about adding your child to your deed, please don't. First, speak with a qualified estate planning attorney who understands California law. If you've already added your child to your deed, don't panic, but you must act with urgency. It is often possible to unwind this transaction with the help of an estate planning attorney. They can sometimes deed the property back to you and then place it correctly into a trust. But this process has its own complexity and must be handled carefully. Time is of the essence. Your home is the cornerstone of your financial life. Protecting it, ensuring it passes to your loved ones with the most benefit and the least pain is one of the greatest gifts you can give them. Don't let a simple but terrible piece of advice destroy decades of your hard work. If you're in Orange County and this has raised concerns, I invite you to take the next step. Click the tidycal.com/Kathy-OC Probate Service link below to schedule a consultation. We can review your specific situation and possibly refer you to an attorney to analyze your deed and lay out a clear plan to protect your home, your family, and your legacy. Thank you for watching.